Welcome to Wealth Matters Podcast. I have with me Caeli Ridge. She's the owner and CEO of Ridge Lending Group, and she has spent the last 22 years as a nationwide lender and loan officer in both residential and commercial transactions. Welcome, Caeli.
Thank you, Alpesh. I'm happy to be here, sir.
Tell us something interesting about yourself.
Okay, I got your list, and I've been looking at it for a couple of days, and I was racking my brain to think about something that might be amusing to the audience. And the only thing I could come up with that I thought might be kind of fun is that before all of this, before my life in residential real estate, I was a pre-med student.
So really? Wow.
Yeah, I find that kind of
pre-med to commercial and residential real estate. Who would have thought? But then again, being a computer engineer, master's, and now in doing real estate, I didn't think of that either.
Right.
So that's funny. So let me ask you this, and of course you are watching this market at the pandemic and then the violence, unrest, etc. You have been watching. You are watching it closely. So how is the mortgage and credit market doing right now?
I think overall it's doing pretty well on the mortgage side. I mean, there's a lot of upheaval, certainly a tremendous amount of uncertainty about what the future might hold. But if we're going to focus on the mortgage side of the conversation, I would say it's improved greatly over the course of the last couple months. There were some very quick and very severe changes early on. Quite a bit of upheaval for the first couple of weeks that people started to panic about. But I think that we've recovered pretty well. Now, certainly it's going to continue to be a few steps forward, one step back.
Right.
But I really think, especially for investors, Alpesh, what I'm finding, and this is great news, I think, that for investors and the mortgage industry, more or less, and I think we'll get into some of the details and meat of this, more or less, it's business as usual.
Right. Yeah, the only thing I saw, especially because I was also raising capital for a senior housing project, and our lender, Greystone, froze all the loans right when we were about to close. So we saw that happening. Oh yeah, and we are still going through it. I'm hoping to close that entire syndication by end of the month, but it's been delayed by a couple of months. Yeah, exactly.
Yeah.
So today's discussion would be around all-in-one loan. AIO is what we refer to, because I heard about it on another podcast from you as well, and I was following AIO market 4 or 5 years ago, and I was surprised that we don't offer something like this in USA because it's very common in other parts of the world. So can you just dumb it down for us? What is an AIO loan or all-in-one?
Sure. So abbreviated, right? I will just give you the high level stuff. Let me first start by saying that this loan product is extremely different than what I think most people here in the United States, kind of like you alluded to, have come to understand mortgage finance, right? We've sort of been conditioned, is how I say, to really only wrap our heads around that closed-ended amortized loan, the 30-year fixed or a 15-year fixed. This couldn't be more different. In fact, I mean, it's a 180 of that. This is an open-ended, right? So it's a line of credit, open-ended, not closed-ended. And is it helpful for me to define what that means?
Yes, please.
Okay.
Yes.
So closed-ended, just basically a simple way to look at it is you make your mortgage payment on your 30-year fixed loan, and that money is gone. You don't get to access it. It's closed-ended. It's closed off. It's paid, and it'll
once you pay it off, if you make a lump sum payment, you are done. You can't do anything. You can't even change maybe one time you can change the amortization, or what is it called, the reorg of the loan or something, and they may reduce the principal payment if you make a large lump sum payment.
That might be some sort of a hybrid. I'm not sure.
Okay. But you're right. Yeah, the money's gone pretty much. You can't do anything with it.
Right. So that's closed-ended. This is open-ended. So that when you make payments against the principal balance, it's immediately available the next hour, the next day, whatever, open-ended. Additionally, you've got a fixed rate over here, and this open-ended revolving mortgage is variable. And we'll talk more about that. So that's just some quick basics. 30-year fixed closed-ended, adjustable open-ended line of credit, okay? The concept is fairly foreign to most people. And let me preface by saying to the audience here that You read off at the beginning some of my background. I've been doing this for a very, very long time. I am a real estate investor. I'm in finance. So typically, I can pick things up pretty quickly. This was a little bit different. It took me a week. Yeah, I had to look at this thing for several days and really kind of dig into it before the light bulb went off, and I was able to understand the mechanics of it, right? The concept itself. So let's just start with that. So this is a first lien HELOC, everybody, that it is in essence replacing the mortgage and your savings and checking account. Okay.
So sorry to interrupt. So when you mentioned HELOC, that's the home equity line of credit. And this goes on first lien. Usually when we get HELOC, we already have a mortgage, and then we get the equity out of the house or the property. If we don't want to refinance, we add HELOC to it, right? Exactly. But in this case, this is a first lien HELOC.
Exactly right. So exactly. So when people hear HELOC, they do think of a second lien that goes behind your straight mortgage, right? They also, that's a good place to start. Let me do that. So they also think of a HELOC where it would be a 10-year interest only draw, and then it turns into the repayment of that HELOC where it becomes principal and interest amortized over the remaining 20 years.
Correct.
That's the traditional second lien HELOC. This is a first lien HELOC. It's the only mortgage or mortgage tied to that property, to that asset. Okay, and it's good for 30 years. This is a 30-year HELOC. So you're able to draw on it for the full 30 years, which is very nice.
Nice.
But the concept of this, if people that are listening have heard the term sweep account or velocity banking, infinity banking, right? That's what this is, okay?
Okay.
So what you would do is you have this line of credit, and assuming that there is a balance on your line of credit, okay, you now are in control, able to dictate or define how much interest will accrue on that line of credit, or on the balance of that line of credit on a day-by-day basis using your own income, right? Your depository income, okay? HELOCs accrue interest on a daily basis.
Daily basis, not monthly like mortgages. Yeah.
Right. It goes daily. And what will happen is that the bank, the lending institution, is going to take a snapshot of every single day in a 30-day billing cycle, and they're going to figure out what the balance for that day was times the interest rate, and then they'll add that up together for 30 days, and that's the monthly interest accrual for that month. Okay?
Got it.
So I think it's easier to give an example. So let's say that we start with a balance of $100,000. Okay? And I make $10,000 a month from all sources of income. And that could be my paycheck, that could be my gross rents, that could be my dividends, my
commissions,
everything. So my $10,000, and I'm just, for ease of explanation, I'm going to say I get my $10,000 on day one of the month. I'm going to take that $10,000 and I'm going to deposit it into my HELOC/checking account. And dollar for dollar, my $100,000 initial balance is now what? $90,000, right?
Right. So
on day one, the interest that's accruing is only on $90,000, not $100,000. So there's some significant interest savings there. The longer I keep my $10,000 in against, leaving it $90,000 as the balance, the less interest can accrue.
Okay? Right. Yeah.
So what the natural progression, most people are going to utilize, let's say, a credit card of their choice, the one that gets the most points and the benefits, whatever. And on that credit card, to maximize the reduction of interest accrual, they're going to pay every cent of their monthly living expenses, and I don't care what it is. Your rental mortgages, your car payment, your credit cards, your food, your gas, your utilities, everything goes on that credit card. But before the credit card accrues any of its own interest, you simply go into your checking account where your money is sitting, right? Which is functional, by the way, and I'll explain that in a second. And you pay off the credit card on day, say, 29. So you've effectively become your own bank. You've utilized your income. About your income or your spending habits, your expenses, nothing changes, right? You're simply now able to utilize your income to drive down the balance that you have due, reducing the amount of interest that can accrue. So there's a compounding effect that's at work there because you're doing this month after month after month, okay? let me quickly touch on the banking features, and then I'll go into compounding effect number 2.
Okay.
So the banking features attached to this particular product are totally automated. Okay, everything that you have right now with your B of A or Chase or Wells Fargo account, online bill pay, a debit card, routing numbers, paper checks if you need them,
Okay.
and an imaging service.
Right.
Right. So if you still get a paper check for rents or something, you can take a picture of it with your phone and upload it.
Oh
to
yeah, same way like
right?
big banks. Yeah.
Right. Exactly the same. Totally seamless, automated. So there's that. The second thing that is at work for compounding, and I don't know if we're jumping ahead, Alpesh, but I'll mention this, and maybe we can, I think one of your other questions kind of asks more about this later, who this is right for. But the monthly residual income of whatever is left over, right? Your savings, that's just another way of saying your savings. If I make $10,000 a month, right?
Yeah.
And I have $1,000 left over every month after I paid everything that I need to pay, then that $1,000 that would normally be sitting in my savings account, maybe doing what?
And no, earning a lot, 0.01%.
Yeah. So instead of just letting it sit in there, now you can just sit it in against your balance. And again, that compound month after month, it just sits there. But this is your money. You have access to it
Right.
24/7, right? You're just utilizing it another way. This is the difference between interest earned versus interest saved.
Yes.
Okay.
That's the key actually, right? Because you may make 0.1% or maybe max 1% interest, but if you are saving 4% interest, that's you can't compare that.
Right. Exactly right. So I mean, is that an overall?
No, that was great.
Explanation? Okay.
So I think I'm understanding now, and of course, just to let listeners know, I'm actually going through a process of AIO loan with Ridge Lending Group right now, and that's why I thought, it would be, great to have Caeli on the podcast as well. So I'm also doing this with my primary mortgage, but I have a mortgage and a second lien HELOC, and I'm doing this strategy using my checking account and HELOC. I'm paying down a lump sum mortgage. Right, but this strategy AIO loan allows you to have first lien HELOC and automates everything. I had to do all of that manually. I had to figure out when I should be paying, and then of course my mortgage is with Chase, and then HELOC is with US Bank, so I had to manage all that. And that's why at that time I could not find any similar product when I started that strategy. But AIO pretty much optimizes that strategy for you, if I am understanding correctly.
Exactly right, and it's pretty smart actually. A lot of people don't realize that just that second lien HELOC, technically you could do the same thing. It's going to take you longer because that's probably a smaller loan amount or line limit on second lien. It's clunkier. It doesn't have the banking features. It's not going to be available for 30 years. It's not going to have some of those other flexibilities. But very smart that you've been doing that organically anyway. This just is the best of all worlds.
Right.
Yeah.
Oh, thank you. So what are the pros and cons of an AIO loan?
I get asked this question a lot. And if you are the right candidate, I think we're going to get into that.
Yes.
And in truth, the math, when we look at it, right, the individual and their qualifying abilities, the math is not going to lie. If this loan is an advantageous vehicle for an individual, I don't know that I would say that there are any disadvantages.
Okay.
If I were forced to say one thing, it might be perhaps, even though this loan looks like it would be very beneficial for the individual, if they don't have some discipline, right?
Yes.
Because what I have heard, so if you have a line of credit that's you've got $500,000 on the line of credit, okay, but you only owe $100,000, you got $400,000 sitting right there, right? Some people may not have the right instincts, and maybe they just say, "Oh, I've got all this equity, all this assets," and they go and they buy a new boat, or they
I'm gonna buy a Lamborghini, or I'm gonna take an expensive vacation, right?
So and so I think that if there were one thing I had to say, maybe for those individuals that feel like they don't have as much discipline where that's concerned, they might get into a little bit of trouble. But knowing that going in, it should probably work itself out.
And I've seen, as I mentioned, AIO loans exist in Australia, New Zealand, and many other countries. why don't we see much of AIO in the US? I know you spoke about it, but is there a reason how the mortgage industry is built? Because we went from 50 years mortgage, 30 years mortgage, and I heard talk about moving it to 40 years mortgage. So do you know why?
Yeah. So you're right. Australia was the front runner, and many, many countries are utilizing this particular philosophy. In the United States, the all-in-one, this particular product has been around for a while. It's just really been not mainstream at all.
Mm-hmm.
Okay. And it's brand new for investment properties, by the way. That's only been around for
Yes,
a year.
I have been looking for it, and that's
Yeah.
why I'm going through it.
Yes, yes. But the reason why ultimately is bottom line is money. So mortgage-backed securities in this country creates a tremendous amount of revenue. When you think about the GSEs, government-sponsored entities, you got your Fannie, your Freddie, you got your Govy loans, Ellie Mae, exactly, trillions of dollars,
Yes.
right? So if I were going to make a guess, that's why.
Yeah, and that's what I have heard too.
Yeah.
So and you also alluded to this as well. Who do you think would really benefit from AIO? Like, who are the good candidates or perfect candidates?
Yeah. So there's an online simulator, and I'll give this to you, Alpesh, maybe you can post it, the link to the online simulator. What this is, you guys, is that it's a way that you can look at the all-in-one side by side, apples to apples, and compare it against a 30-year fixed, for example, and see. It's a very short intake. At the end, when you're looking at the results of the simulator, like I said earlier, the math will not lie. Okay, it'll tell you very clearly. You'll see side by side if the all-in-one is going to be useful. It'll tell you how much interest that you would save, how many years you'd shave off. There's a bunch of great information on that results page of the simulator. But what I can tell you in general terms, we find that the individual that is not able to save that residual income that I talked about, at least 10% a month, the simulator results are not going to be to their advantage. So generally speaking, if you're saving at least 10% of what your depository income is, the all-in-one is usually going to be a good move for you. If not, probably not the right product.
Got it. Is there anything else someone should keep in mind when they are looking to, let's say, cash out refinance and comparing to AIO? What else they should be looking at?
You mean in terms of the simulator or just in general?
In general.
Yeah. Well, okay, let's play devil's advocate.
Yeah.
The 30-year fixed compared to the all-in-one, and we're talking about a cash out refinance. And I don't think it really matters if we're talking about a primary or an investment property.
Right. It doesn't matter.
It's going to be right 6 to 1. I think that what I would anticipate they look for is the 30-year fixed is going to be a fixed rate mortgage, right? You don't have to worry about it. Rates are really low right now. The disadvantage to that is the cash out, you're receiving it on day one, which means paying interest on all of that on day one, whether or not it's deployed out there for whatever your purpose for, right? Versus the all-in-one allows you to pay as you go, right? You take a $20,000 draw, or you take $20,000 out of the equity, you're only paying on what you're using, I think is a good comparison.
Yeah, it's pretty much a credit card.
Exactly. Now, the downside on the all-in-one is that for some people, they hear variable and they get a little bit freaked out. So you got a fixed rate, conservative for sure, et cetera there. Here it's a variable. It's got a lot more flexibility. You're only paying on what you have. Can we talk real quick, Alpesh, about variable versus fixed?
Actually, I was going there because I thought I'm going to throw a curveball at you, but you brought it up because that's one of the things when even I speak about that, using HELOC to pay down your mortgage, everyone comes up with that. Oh, it's a variable rate. I'm only paying 3% interest now. Why would I go to 4%, 5%, right? So yes, please go ahead.
Well, so let's tackle that first thing first. So when you think about a fixed rate mortgage, and even if it's a very low rate of 3%, okay, the amount of interest that loan is going to accrue is predetermined. When you get your loan documents and you sign them, there's something called a TIL, Truth in Lending, that tells you, here's the principal amount that you borrowed, but here's what you're going to end up paying over 30 years. And it's usually twice the original, right? So when you think about it in those terms, that amortization of how it is stretched out over 30 years, you end up paying a significant amount more in interest than you would on something that's even variable that you have control over because
Right.
your income is now in charge of driving the balance down, saving you that interest. There really isn't a comparison. There is a good analogy. So if you have I'm forgetting it. It's a comparison against the 30-year and a 15-year. And let's say that the 30-year is at a 4% interest rate, okay? And the 15-year is at a 7% interest rate, okay? And same loan balance. Let's say it's 400,000, okay? If you look at those side by side, initially, most people, their mind goes straight to the 30-year 4%. Of course, the 4% is going to be less interest, when in fact, you pay less. You pay about $40,000 less in interest on that 15-year at 7% than you would the 30-year at 4%. So that just kind of helps illustrate the point. The other thing I want to talk about when we speak about adjustable rate mortgages, where this one is concerned, let's go over some specifics. So when we talk about an ARM, adjustable rate mortgage, there's two primary components, okay? You have an index, which is the variable piece, and there's dozens of indices out there. The Treasury, people know the 10-year Treasury, right? That's an index. The LIBOR is
the one most of us follow,
Right, for mortgages. LIBOR is usually used mostly for mortgages, exactly. London Interbank Offered Rate is what that stands for. Where this particular product is concerned, it's the 1-month LIBOR that it's tied to. So LIBOR has a 1-month, a 6-month, 1 year, I think, is there a 5-year LIBOR? Anyway, so this particular loan is tied to the 1-month LIBOR. So the index, you got the index, variable, can move, and then you have a margin that's fixed. It'll never change for as long as you have that loan. That margin stays exactly where it started. You add those two things together, and that equals your fully indexed rate, okay? So this gets a little bit convoluted, so I'll try and be clear. So every adjustable rate mortgage comes with their own safety net, their own safety net.
Yeah, there's a floor, right?
A floor and a cap.
Yep, and a cap, yes, correct.
Exactly. So in this case, there is a life cap. Some adjustables, if it's like a 5-year adjustable, there's several caps. On a HELOC, there's just one number. And it is, in this case, 6% over the initial fully indexed rate. So right now, let's just say the fully indexed rate on this all-in-one is, I think it's 3.9. Okay. That's today. If you were locking the rate in today, 3.9. The life cap is going to be 6% over that initial fully indexed rate. So 6 plus 3.9 is clearly, right? Yeah. Say that again.
6 plus 3.9, so it's like close to 10%.
Sorry. Yes. 9.9 would be the life cap. So that means that over 30 years' time, your interest rate, no matter what happens with that index, up, down, east, west, whatever, it could never exceed 9.9%. Okay. Now, I'll give you another piece of information. On the 1-month LIBOR specifically, if you look at a 25-year historical average, and this would be kind of good information to have. So I encourage everybody listening to do a Google search of the 1-month LIBOR. The information's endless, but you could get a printout that shows every single month of that index for the last 25 years.
Wow.
You can kind of see how this index moves, how often and by how much. You'll find it's a pretty steady, slow-moving index. But what I wanted to point out is that the highest it's ever been was in 1989, and I believe it was 10.08 was the highest the index has ever been.
That's it. Yeah.
The 25-year average is 2.67, I believe.
That's not bad. That's really good.
Yeah. So, I won't go too far down that rabbit hole, except to say, educate yourself about the adjustable mortgage, okay? Lastly on this topic, let's focus on the 30-year fix for a second. It's a psychological thing, people, and I'm guilty of it myself.
Yes.
But let me put some statistics in perspective. The percentage of people that keep a 30-year fix from the day that they close on it for 360 months is less than 1%.
Yeah, I don't think anyone gives it.
It just doesn't happen. And in fact, on a primary residence, and I'm sure that the average is lower on a rental property, but the average lifespan of a 30-year fixed for a primary residence right now is 7.8 years. So,
which makes sense, right? Most of us move around.
Right.
And then, of course, refinance constantly, right? But yeah, if I don't see anyone staying in the same property for more than 10 years. It's pretty hard.
Right. So don't be afraid of the adjustable until you do math, right? Anyway, that was a long-winded
No,
answer.
that was a good one. Another curveball at you is I hear another argument is that, oh, I'm able to write off that interest. If I pay it off in 10 years now, I'm like, yeah, that's good. You're free and clear mortgage. But I can't now write off mortgage from my taxes.
That's not true. So the newest tax law, and always make sure you're up to date and you're doing your own homework, but the way it's written right now, this is exactly the same. There's no difference between this and a 30-year fix. The rule says as long as whatever you're using, the interest that is being paid was used for home improvement or real estate purposes, right? If you're doing cash out,
yes.
Right, if you're pulling cash out of your home, that interest is only deductible if it was for home improvement or real estate
or
purposes.
acquiring real estate. Yeah.
Right, that is the same exact thing here. So if you're refinancing one to the other, you should have no problems that you're absolutely able to write off that interest.
Got it. Anything else we forgot about AIO before we take a break?
Yes, actually, let's talk about how it's repaid, right? This is a 30-year HELOC. Yes. How does it work at the end, right? So we talked about a second lien HELOC in that it's a 10-year interest only draw. And then after that, it becomes a principal and interest, can't draw on it anymore, over the remaining 20 years. It's amortized over 240 months. So on this loan, what happens is that in month 1 of year 11, the limit starts to reduce ever so slightly by 1/240th%. So let me define that again. So the 240 in that number represents 20 years. So if we started with a limit of 100 grand, just for round numbers, we have a limit of $100,000. In month 1 of year 11, that limit is going to go down by 1/240th, making the limit from 100,000 to 99,760.
Oh.
Right?
Yeah.
So inconsequential. But every month you'll see that that's what's going to happen until the 30 years.
Okay.
You're still able to draw on it for the full term of the loan.
Right.
The limit starts to go down a little bit.
I see. No, that was great. Thank you so much, Caeli. Let's take a quick break.
Okay.
Welcome back to Wealth Matters Podcast. I am chatting with Caeli Ridge about all-in-one loan. And this is a fire round, Caeli. Now, I go through these questions every week with each of my guests. So, and I have added some of the questions because of what we have seen with the pandemic and then the unrest. So what do you see would be short-term and long-term impact on the mortgage market and real estate because of coronavirus?
So certainly there are immediate impacts that we've been seeing, we've already seen, and that we continue to see. This gets quite detailed. I will share with you currently what some of the more negative impacts we've seen because of the virus. The CARES Act, let's talk about that for a second. I think that they acted very quickly. Congress acted.
Oh yes, I was very surprised.
Right?
I'm not impressed, but I was impressed with the Congress.
They moved fast. And as a result, I think that there were some unintended consequences that came along with it because they didn't have the time or they weren't able to take the time. The intentions, I think, were there. But as it relates to mortgage, let's talk about forbearance. Okay. Yes. This has been a big topic in my industry. Yeah. The problem that they made, the mistake that they made with forbearance in the CARES Act is that it required no hardship. Okay. Yep. That's bottom line. Yep. And with that came somewhat of a moral hazard that people that really probably didn't need it are taking advantage of it. Yep. So a few things have happened with regard to that. The first is that mortgage-backed securities, quick definition. So the servicer, right, the company that services your mortgage loan that you make your payment to that is then responsible to disperse the funds accordingly, the principal, the interest, the taxes, the insurance. If I don't make my mortgage payment to my servicer, the servicer is not off the hook. They're still obligated to stroke that check. They have to pay the note holder. They have to pay the county, the taxes, and the insurance. So as an unintended consequence, what we saw was huge liquidity issues because people they ran for this forbearance because the way that it was presented, it's not going to affect your credit score, right? I mean, it just sounded too good to be true. And people that just aren't in this space didn't realize what that meant, right? Mm-hmm. So the servicers were taking huge hits, into billions and billions of dollars. And what that translated into is that on the secondary markets where mortgage-backed securities are concerned, they weren't moving. The Fed stepped in And to date, I think the last time I heard, and they've really kind of eased off of this, and they needed to, but we won't go into that conversation right now. They were buying billions and billions and billions of dollars of mortgage-backed securities to keep the cogs going. I believe last time I heard they're up to about $750 billion over the last 3 months of purchasing mortgage-backed securities to keep some of that liquidity. So that mortgage-backed securities were moving. Now that's not really a help to the servicers.
Right.
They've been given some liquidity facilities to help kind of that barrier just kind of move across that bridge a little bit. Liquidity facility just is a fancy way of saying lines of credit. Okay?
Yeah, okay.
The government has provided them that so that they can keep their liquidity here while the forbearance stuff kind of starts to move and people start making payments again, et cetera. But it did affect secondary markets. It did affect pricing and interest rates for a time. So that was a big problem. More than that, though, the language in which it was displayed and given to the consumer, they were told that you don't have to prove any hardship. And for anybody that is listening to this, they know how easy it was. They probably made a phone call. Here, you got a forbearance. You don't have to make a payment for 12 months, right? The problem with that is that while it's true, it will not affect the individual's credit score, okay? Initially, the lenders, because the servicer and the lender aren't the same thing, right?
No, yeah.
No. So it was showing up on a credit report within the mortgage trade line saying forbearance or deferment. Score is intact. There's no mortgage.
Yes, score's not going to change, correct.
Right. But the trade line itself was showing when we would pull our client's credit, it showed deferment. Those people were not eligible for loans. They couldn't get financing. They can't make this payment. We're not going to give them money for something else.
Of course, if you are having a hardship, how can you get another loan?
Right. So, but that wasn't communicated, and people didn't realize.
Yeah, people didn't. Yeah.
Right. So that was a little bit frustrating, and we've kind of worked through. I was talking on that almost daily for a couple of weeks. There have been some improvements to it right now, as long as the individual. So at first, let me back up. At first, when we saw that, we were told that it could be 12 to 24 months before these guys were eligible for financing again after they got off deferment. That's changed. Now, as long as they make the payments current, they can't defer them or forbear them on the back. They have to make everything current, right? And if they made 3 consecutive payments, they're again eligible. If they missed one, if they missed a payment, they have to bring it current. They got to bring whatever the past due is current. They have to make 3 consecutive payments, and then they're eligible again. If they just went into forbearance just to have it, and they haven't made any late payments yet, right? They haven't missed any payments yet, then all they have to do is remove the forbearance and we can move on immediately.
Okay? Which makes sense, yeah.
Yeah. So anyway, in terms of what we're seeing, what we expect to see into the future, that was one of the big ones as a cause of the coronavirus. There's been some casualties to our industry.
Right.
Non-QM is gone. For those that aren't familiar with that term, QM stands for Qualified Mortgage. Right. So this is basically, you guys, everything outside the confines of Fannie, Freddie, FA, FHA, USA, USDA, VA,
USD.
right? This is the what maybe you used to know as subprime. Okay, this is what we handle everything else outside of what the government loans would provide for us. That disappeared very early, gone, evaporated. Now there's been some early rumblings. I don't want to set the wrong expectation, but some are saying that we might see a non-QM come back sometime this year.
Oh, okay.
So that's good news.
Let's hope so.
Yeah. Jumbo dried up very quickly.
Oh, yes.
Back on the rise. I think that's what you were dealing with, right?
Yes.
Yeah.
Yes, that's correct.
Anyway, so those were some immediate issues that we dealt with. Let's talk about futuristically what we will. The good news is rates are going to remain low. Okay.
That's a
foregone conclusion. I can almost guarantee you we're going to have low rates for the foreseeable future.
Yeah.
And when I say foreseeable future, I'd say a couple of years.
Yeah, at least, yeah. Yeah, right? if we brought them down to almost zero, then yes, at least a couple of years, and 5 trillion can buy a lot.
Right. So that's great news. I will tell people that because of what happened in mortgage-backed securities and servicers and all of that, and I didn't go into great detail because it's a lot of mortgage jargon that is not going to make sense.
I recommend everyone to watch The Big Short.
Yes. Yes.
So we don't have to.
Right.
That's the best.
But what I think we're going to find on a go forward, we're going to have great rates, but I believe that the powers that be are going to probably update credit criteria, reserve
Okay.
criteria. I think qualification might be enhanced a little bit. So whereas before we had to show this much in reserves to get a mortgage for a rental property, now we have to show an extra month, an extra 2 months.
Yes,
Maybe
I
credit
have.
scores.
I'm already seeing that in the commercial side. So
Right.
yes.
So I would say that that's kind of where we are now, where I think we're going to be. Those are just a few quick details that I think that's what you were asking, right?
Yes, yes.
Yeah.
Would you be changing any business or investment strategy after coronavirus?
Investors are doing great. I got to be honest. Investors are doing great right now. Rates are so low. There's enough inventory as far as I can see. I don't see a big restriction on what housing is providing out there, at least for the non-owner occupied side. So, and the nice thing too, Alpesh, if you think about the restriction and requirements that I just talked about, it's funny because this is the first time investors haven't really taken it in the backside.
Yes.
You remember 08, 09,
That is
right?
correct.
When
It
that
was
happened,
bad.
it was so bad. We
Yeah.
went from having unlimited amounts of access to credit to zero.
Yeah,
And
nothing.
post 20% down minimum, 720 or greater credit scores, all these
Yes.
reserves. So we've been living in that world for 10 years,
Right.
right? So now, because of that, that's why I was saying kind of business as usual. We're still in the driver's seat where that's concerned. The qualifications have tightened a little bit, but we're used to that. Investors are used to that.
Yes.
But to answer your question, I think that commercial property is going to see some big changes. I think that because of the forcing of the quarantine and people having to be working from home, I think
Yes.
commercial space is going to take a big hit.
Yeah. Oh, yeah. Retail, office space for
Right.
sure.
I mean, I can see, so I'm in class, I don't know if you can see around me, probably not, but I'm in a very large office space. It's got multiple buildings,
Okay.
Class A office space. And a lot of people are, I can see it. They're just, even though we're kind of just phasing back into opening, I really think that it's going to feel like a ghost town around here.
Wow.
Yeah, on the commercial side.
Yeah.
But otherwise, I think it's going to be market specific, as it always is.
Right. Yeah. Absolutely. It's a real estate is market specific, and I'm hoping that the East Coast and West Coast may slow down a bit. So let's see when that happens. Favorite real estate or finance book?
I'm going to have to say Think and Grow Rich. The Napoleon Hill.
Napoleon Hill. That's a great book. Yeah. Any tool or website you can't live without or you highly recommend?
I don't know if it's going to mean anything to you guys. So Optimal Blue.
Okay.
Where it's a platform, an app that I'm going to go to for secondary pricing and loans and interest rates and things.
Awesome.
Yeah.
Thank you so much. How can my listeners reach out to you?
Yeah. So a couple of ways you can reach us. Our website, obviously, ridgelendinggroup.com. You can call us toll free at 855-747-4343. 855-74-RIDGE is an easy way to remember, or they can email us at info@ridgelendinggroup.com.
Awesome. That was great. Thanks again, Caeli.
My pleasure. Thanks for having me.
Take care.